In 1990, the U.S. economy looked steady, confident, and slightly overfed, like a cowboy after 3 steaks and no belt. Then oil prices jumped and bank credit dried up fast. Turns out recessions don't send invitations ahead of time. This was the 1990 to 1991 recession, officially dated by U.S. business cycle referees. Yes, that is a real job title. The downturn ran from mid-1990 into early 1991, short on paper, long in unemployment lines. 2 forces teamed up like an outlaw duo, an oil shop and a credit squeeze. No horses, just spreadsheets. One came from war in the Middle East. The other came from wounds inside American banks. August 1990, Iraq invaded Kuwait under Saddam Hussein. Oil markets reacted faster than traders at free lunch. Kuwait was a major oil producer, and traders feared supply disruption. Fear is gasoline for price spikes. Crude oil prices surged sharply within weeks. Businesses suddenly recalculated everything with a frown. Higher energy costs hit transport, manufacturing, and household budgets. Even morning coffee got more expensive to deliver. Consumer confidence started slipping before layoffs even began. Bad expectations can spend money faster than reality. Markets hate uncertainty more than bad news. At least bad news shows up on time. Military buildup for the Gulf War added tension to forecasts. Economists dislike surprises unless they are birthdays. Energy volatility feeds inflation fears and cautious spending. Wallets snap shut like saloon doors. But oil alone didn't cause the recession. Trouble was already brewing in the credit system. The savings and loan crisis had damaged hundreds of lenders. Bank balance sheets were limping, not sprinting. Regulators tightened standards after the S&L failures. Loan officers suddenly discovered the word no. Commercial real estate loans were hit especially hard. Empty buildings don't repay enthusiasm. Small businesses found credit lines reduced or canceled. Expansion plans went back in the drawer. When banks stop lending, growth loses oxygen quickly. The economy starts breathing through a straw. Credit contraction reduced hiring and investment together. That's a double punch with no referee. Construction projects stalled across several states. Half-built sites became modern art nobody ordered. Regional banks were especially cautious with new loans. Risk appetite packed a suitcase and left town. Meanwhile, interest rates had been raised in earlier years. Policy medicine sometimes has side effects. Federal Reserve Chair Alan Greenspan faced a tricky balance. Fight inflation or rescue growth first. Rate policy shifts take time to hit the street. The economy moves slower than campaign promises. President George H.W. Bush faced rising economic pressure. Voters count jobs, not policy footnotes. Treasury Secretary Nicholas Brady worked financial stability angles. Calm voices are useful during money storms. Policy debates rarely look dramatic on camera, but the consequences sure do later. By early 1991, recession conditions were clear. The jobless recovery chapter was just getting started. Banks entered 1990 already bruised from the savings and loan collapse. When lenders limp, credit doesn't run very far. More than 1,000 S&Ls had failed by this period. Taxpayers became unwilling investors without voting rights. New rules forced stricter lending standards nationwide. Loan applications faced more questions than a suspect in a Western. Commercial real estate became a danger zone for banks. Empty offices don't pay rent out of kindness. Property values dropped in several major regions. Collateral shrank faster than banker confidence. Without solid collateral, loans were reduced or denied. Expansion dreams met very small approval stamps. Small firms felt the squeeze first and hardest. They don't keep spare vaults of cash. Equipment purchases were delayed across industries. Old machines earned unexpected overtime. Hiring slowed even before layoffs peaked. Help-wanted signs quietly disappeared. Manufacturing orders weakened across several sectors. Assembly lines learned the meaning of idle. Defense contractors faced shifting demand during Gulf War buildup. Government checks are steady but selective. Consumer lending tightened for cars and homes. Big purchases suddenly required heroic paperwork. Mortgage approvals took longer and failed more often. House hunting became character building. Construction employment started sliding across states. Hard hats waited for softer markets. Credit contraction works quietly but hits widely. It is the silent partner in many recessions. The Federal Reserve had raised rates in 1988 and 1989. Inflation worries were still fresh in memory. By 1990, conditions argued for easier policy. Timing that shift is never simple. Rate cuts began as recession risks grew clearer. Monetary policy turns like a large ship. Chair Alan Greenspan signaled growing downside risk. Markets listened closely to careful wording. Lower rates aimed to restart borrowing and spending. But confidence must also cooperate. Businesses stayed cautious despite cheaper rates. Burned once, they read the fine print twice. The White House tracked recession signals closely. Elections and economics are close neighbors. President George H.W. Bush pushed growth messaging publicly. Voters prefer paychecks over reassurance. Treasury leadership focused on financial system stability. Confidence is cheaper to keep than rebuild. Output began stabilizing before employment recovered. That's the jobless recovery pattern starting. Unemployment kept rising after growth resumed. Statistics can feel rude like that. Households reduced discretionary spending sharply. Luxury took an extended vacation. Retailers adjusted inventory and staffing levels. Sales forecasts lost their optimism. Regional differences shaped how pain was felt. Some cities slowed, others stumbled. By late 1991, technical recession had ended. The labor market didn't get the memo yet. The recession officially ended in early 1991 by business cycle dating. Unfortunately, layoffs did not read the memo. Employment lagged behind output for many months. Recovery showed up late, like a cousin owing money. This pattern earned the label jobless recovery. Growth returned first, jobs caught the next train. Banks slowly loosened lending after balance sheets improved. Caution stayed in the building, though. Regulators pushed stronger capital standards afterward. Guardrails went up after the skid. The savings and loan cleanup continued into the decade. Financial housekeeping is never quick work. The Gulf War ended quickly, but uncertainty lingered. Markets prefer boring headlines and steady oil. Oil prices eventually stabilized after the conflict. Energy panic cooled down from a boil. Lower oil volatility helped business planning recover. Budget forecasts became less dramatic reading. International banks also reviewed risk controls. Cross-border lending got stricter questions. Credit risk models were revised across institutions. Spreadsheets earned job security. Stress testing became more common practice. Banks started asking what if more often. Workers changed careers after layoffs hit sectors. Reinvention became a full-time job. Community colleges saw rising enrollment numbers. Tuition replaced time clocks for many. Families adjusted budgets and spending habits. Coupon folders gained sudden popularity. Small businesses learned to operate leaner. Efficiency stopped being optional decoration. Entrepreneurs who survived became more cautious planners. Optimism kept a calculator nearby. Local banks rebuilt trust customer by customer. Handshakes returned before bold promises. Policymakers studied the dual shock carefully afterward. Oil and credit proved a risky combo. Central banks improved communication strategies in the 1990s. Clear signals calm wild markets. Bank capital rules strengthened through the decade. Shock absorbers were officially upgraded. Risk concentration became a bigger warning sign. Putting all eggs in one loan basket frowned upon. Economic historians mark this recession as structurally important. Short duration, lasting lessons. It showed how finance and geopolitics collide fast. Markets travel quicker than diplomats. The economy recovered, but scars guided future policy. Experience is an expensive teacher. Oil shocks still matter in modern cycles. Energy prices remain powerful mood setters. Credit conditions still drive business momentum. Lending is economic oxygen. Watch oil, watch credit, watch confidence. That trio writes many downturn stories. And remember, recessions rarely arrive alone. They usually bring a friend and eat your lunch. That was the 1990 to 1991 recession story. Short ride, rough trail, useful lessons.